And we are live with none other than Ken Book. He is CEO at FluidInvesting.com, YC startup that caught my attention. Really cool idea. Typical YC founder, but on the East Coast. So still very much a hustler, cracks 15 hours days, high intellect, good business idea, high chances to make it. I'm so bullish on YC startups. Let's see how Fluid does. I really liked the idea last time that we spoke, but Ken, can you introduce yourself and tell us a bit more about Fluid?
Yeah, for sure. So first off, thank you for that overly warm introduction. I hope everything you said is at least half true. Yeah, just a quick background on myself. So I'm Ken, was interested in finance for a long time, ultimately found myself for a brief stint at Goldman Sachs, where part of the time I spent there was in a group called Credit Solutions, where we created these bespoke derivative products for clients. And what I realized there was that you can really create a financial product for just about anything if you figure out how. And meanwhile, on the side, I had my own portfolio, and I realized that I wanted to invest in YouTube, but you couldn't invest in YouTube because it's owned by Google. And so I realized, wait a second, there's got to be a way to invest in YouTube without investing in the rest of Google. So I went to Ben, who's now our CTO, and he was a quant at Goldman at the time, in that same group I was a banker in. And we basically brainstormed and figured out how to create an investment in YouTube, not Google. Now, since then, we've expanded to not just YouTube and not Google, but any key KPIs of public companies. So we're enabling you to invest in a company's earnings or a company's revenue, or if it's Netflix, for example, net subscriber growth, things of that sort. So we're creating an investment platform that lets you invest in KPIs for public companies, such that when you make your investment, you can actually understand that if your thesis is correct, you can actually make money every time. And that's what's lacking right now in the public markets. You can be correct in your thesis. If you think a company is going to beat on revenue or earnings, you can be correct. But for an infinite number of reasons, the stock can still fall. And so that's the problem we're going after.
And how do you do that technically? Because the idea is really interesting. It allows me for safer and more accurate predictions. Let's call it that way. How do you do that technically on the backend side of things?
Yeah, so it's going to be structured. So again, we're not live yet because we don't have full regulatory approval yet. I guess now is an interesting time to say this, but we're actually launching a paper trading competition very soon. So check back on our website in just a couple of days. Definitely by Monday, we'll have that up. And that paper trading competition will let you actually simulate real trading in our markets as if they were fully live, and you can actually earn real cash prizes in the thousands of dollars. How it's going to be structured ultimately is it's going to be structured as a futures contract. The underlying asset in this futures contract is going to be an index that tracks the performance of any of these given KPIs. So if you think revenue for Google, for example, is going to be $50 billion in a quarter, and you go long at 50 and it ends up being 52 billion, you would end up with $52. If I went short at 50 and it went to 52, I would end up with $48. So that's kind of how it works mechanically.
All right. And okay, index, but an index, typically when I invest in one, it's an aggregation of multiple stock prices. You're betting on KPIs. It's kind of so an index, you actually buy the bet, like I still don't understand like the mechanics, who would do what.
Yeah, good question. So there are two questions there. Number one is, what do we mean by an index? And number two is, how do we actually get you these returns? So when it comes to question number one about the index, an index doesn't have to be a big conglomerate of a bunch of different things. An index just means a number that's published that tracks something. Okay, so oftentimes you don't need a number to track what happens to Alphabet stock, because Alphabet stock is already being tracked. But if you have a conglomerate of Alphabet and Netflix and a bunch of other and 498 of the biggest companies, right, then you would want an index to kind of show you what that average is. But when it comes to our case, we just need a number that's published for it to be the source of truth for this contract. So because of that, we're making an index that just tracks that one number, and that's its whole purpose, is just to be the source of truth for this contract. The way we actually offer it is it's a two-sided marketplace, right? So if one person goes long at a certain price, that's because somebody else went short. And so just like in wheat futures, right, the way the CME, which is the biggest futures exchange, is able to offer you your returns on wheat futures is because anytime you went long, someone else went short. So we're going to use those same mechanics there to make sure that we're able to actually pay everyone out based on their earnings.
Right. And I told you that yesterday I was building Charlie's Almanac GPT. I was also uploading annual reports and creating chatbot out of them and creating cold email for public companies. So is that how you track the metrics from annual public reports or quarterly reports?
Yeah, well, that's great, and I'd love to see what you end up making with Charlie GPT. But at least in our case, we just buy it from a data vendor because we don't want to have any hallucinations that at this point AI seems to have pretty regularly.
Right. And how do you make sure that the data is accurate in those reports? Is it like validated by a third party or generally accepted that this provider has accurate data?
Yeah, so it comes directly from the SEC's database. The companies report it directly to the SEC, so it's straight from the source.
Straight up. Okay. Now, I still have questions as per the mechanics. So what would be worth one share? Let's say that I'm betting on YouTube's subscription, right? They were supposed to have 5 million this quarter. They ended up at 7.5. And the bets, do I have options in terms of bet? Can I bet on 5 million new subscribers? Can I bet on 6? Can I bet on 7? How does that work? Do I have options?
Yeah, so that's a good question. You can place, just like with a stock, for example, if a stock is currently trading at $10 per share and you think it's worth $15 per share, you won't go to the NASDAQ and place an order for $15 and they give you odds for it, right? That would be much more like a sports book, right? If you went and said, I think this is going to happen, then give me odds. What happens is you buy until it reaches 15 or until you have your desired exposure. And the difference between 10 and 15 would be your profit. So same here, right? If the market currently expects there to be $1 billion in earnings for a company, and you think there's going to be 1.5 billion, you would just buy at the market price, which is $1 billion, and your profit would be the difference between that and 1.5.
Okay, and on the back end, who keeps track of that? Who's accounting all of these difference? Do you have a software for that, and you need to get an approval? How does that work? I'm curious as for the back end.
Yeah, so all of our back end is going to take place on what's called the DCM, which is a designated contracts market. It's a CFTC designation for what in layman's terms we just call a futures exchange. And so futures exchanges are heavily regulated. We have matching engines, all futures exchanges have matching engines, which is this technology that keeps track of everyone's bid and everyone's ask. So basically any type of order. And it submits all the data that's legally required at the end of the day to a public database. And if you look at any DCM right now, so for example, the CME, ICE, which actually owns NASDAQ, they're the second biggest DCM. So if you actually look on their websites, you can see lists of all of their data. Everything's public. So we're going to be listed on a DCM.
How long does it take typically, and how much does it cost to be listed up there?
Well, it depends. There are a few ways you can go about it. If you're building your own DCM, it's millions of dollars in a couple of years. And if you are not building your own DCM, it's anyone's guess. So we obviously have our strategy towards getting them listed fully with full compliance in a cost-effective way. But it's not cheap.
So I guess the first initial capital, I mean, you got probably 200K from YC. Are you raising pretty soon? When and what's the next round?
Yeah, so we actually closed our pre-seed round a few months ago. We haven't made a huge public announcement about that, but that was a nice round we did. So we're not actively raising, and we don't anticipate raising in the near future, but 1-2 years down the line, anything can happen.
So let's call that pre-seed 2 million.
I'm not going to go into exactly what it is, but it's not so far from there.
All right. Thank you for the details. My brain is a bit more familiar with the topic. I also had the blockchain keyword popped while you were speaking. Why not build all of that through blockchain? Because yeah, the SEC has been cracking down on blockchain. I feel that this technology could be more simple than building your whole backend, or maybe it's straight up required by SEC to go through the process that you're going through right now. What do you think about that?
Yeah, so the blockchain is a touchy subject right now, obviously. I mean, a year ago it was much more in vogue, but it's still fairly popular. Um, However, it's not that popular with regulators. When you want to get something approved and do something, I'm not saying blockchain isn't the right way, but if you want to guarantee that you're doing something the right way, you want to make it as vanilla as possible. You only want to innovate where you have to innovate, and you want to make it recognizable by the regulators as stuff they've seen before, and that's been okay. And especially in the wake of the FTX drama and a million different crypto news stories going through the headlines, keeping things off the blockchain is just a much more simple, plain vanilla way to do things, especially since there's no real added value for us to be on the blockchain. We were actually talking with the vendor once that we were thinking of working with about tokenizing our securities or our product. And it's funny, I asked, like, so what good, like, what added value does tokenization have? And he said that, well, listen, you can say it's tokenized. And I'm like, what does that mean? He's like, well, you can say it's on the blockchain. And I said, well, does that add any value? And he's like, no, but some customers like saying they're on the blockchain, it helps them raise money. So again, if it doesn't really add value, it's not something we're super interested in.
To continue on the backend details, you're kind of schooling me with like how the stock market works here, but the thing you mentioned there, and when I invest, it automatically puts my money in some pot. And if the person decides to, okay, yeah, I think I understand. If someone decides to sell, another can buy, and that's where the money comes from. Now, on your end, how do you make money off that? You know, is it per transaction? Tell us a bit more about that aspect.
Yeah, so we make money in two primary ways. Number one, we make money on a transaction, just like any given exchange. When you place a trade on an exchange, you pay exchange fees. And then the other way we plan on making data is by monetizing the other way we plan on making money is we plan on monetizing the data. So we'll have incredible data on we're not going to sell your user data at all. We're just basically saying, hey, look, these are the orders that were placed on Amazon's revenue share. And then that might give investors a better understanding of, oh, look, here's what people think Amazon's revenue is going to be. It'll kind of just be like another equity research report.
Fascinating. Yeah, and like, yo, let's hurry up, else we're gonna get or ask it on the next quarterly report. Sort of, what other creative pricing or monetization models have you thought about? Because yeah, that one, the transaction, that's pretty normal. Selling the data is another one. What else do you have in mind?
Yeah, I mean, those are the big ones. Again, right now we're more focused on getting this product up quickly and legally and affordably. And once we get there, I mean, we'll look at monetization. But first off, we're just trying to get something up, make sure we're fully compliant, and make sure that we're actually providing something people want.
Would you like to try the eToro model in the phase 2, like have copy people's bets, build a community out of it? Wouldn't that be fun?
Yeah, it could be fun. All things to explore, but I think those are second level things to consider. Whereas right now we're just trying to nail the basics.
Right. What's your growth strategy to acquire users?
Yeah, so strategy number one is coming onto podcasts like this, talking with people about what we're doing, really spreading the message. We're actually about to launch our own podcast coming very shortly. We have one episode already in a soft launch. It's called Metrics and Markets. You can look it up on Spotify. But again, it's just getting the word out to people. We have a few different marketing techniques that hopefully, if we do it right, you guys will see in the coming weeks.
How's YC played for you so far? Who has been mentoring you, and how has it potentially changed the game for you?
Yeah, YC is great. YC, I mean, in terms of mentoring us specifically, everyone is placed with a specific group partner who has experience speaking with and helping companies in your space. And so for us, that's been super helpful. We really like and respect our partners. And then when it comes to other companies, right, the peer group is really incredible. So there are a bunch of other fintechs that provide a lot of support to us, and they're just great for talking things through.
I want to give the folks a glimpse of our last convo about AI, which was very stimulating. I can't help myself but think that in 5 years, there's going to be some form of AGI on the market that's going to totally dominate or obliterate everything until it reaches equilibrium when there will be other AGIs competing against it. Do you share that vision?
You're talking about in terms of stock market trading?
Yes.
So we've been over this, but I'm happy to share the conversation with everyone. I don't believe that that's going to be the future. If you look at markets already, information that's publicly out there is already mostly, if not entirely, priced into the market. If you look at the hedge funds that are already operating at massive scale, they already analyze big data in a trillion different ways we couldn't even imagine, trying to find every single correlation to the past and making sure that it's currently priced in. And so the reason that the stock market prices change is because things change in real time, and that's not going to change, right? You can have an AGI perfectly pricing something at $10 today, but it's priced at $10 today because it's expected to be priced at $12 a year from now, right? So then that still happens today, right? Something's priced today based on its future value discounted to its present value, weighed obviously for the probability that it actually ends up getting there. So the algorithms might get sharper. You might get more precise pricing, but that doesn't mean that pricing won't change, because things change in real time, and these AGIs won't be able to predict the future with 100% certainty.
Yeah, because my brain's asking itself, has it not been done because finance is like Wall Street and Broy? But I mean, there's been Citadel and other companies that have attempted that. There's been Numerae, I believe, that attempted this. And yeah, they probably tried, because the open AI model is just reuniting the best scientists in the world in one room. They did it for the text industry, copywriters, knowledge workers, and so forth, consultants. I think consultants are going to eat it in the next couple of months. I'm building GPTs to like fully AI avatar them. And yeah, it seems like a good solution short term, right? But yeah, interesting take. Go on, Ken.
Yeah, I mean, just think of it this way. Finance is the one area where you have a very clear path to monetization if it's possible to make a good AGI for it. And so if they've already done it with areas like copyright and other industries, you have to think why it hasn't hit finance yet. And the answer is because finance has been using big data for decades already, and it's already pretty advanced, and it doesn't take away trading, right? You can still, things still change over time, prices still change over time, and that's not changing anytime soon.
Right. And nowadays I'm studying the history of public stock exchange, Toronto Stock Exchange, New York Stock Exchange, Singapore Stock Exchange, and I'm learning quite a lot. Have you studied the history of these, and what insights have you learned from the history of stock exchanges?
Ooh, that's a good question. Yeah, of course we've been studying the history of stock exchanges. There are a few good books that I recommend specifically regarding the history of futures exchanges, which people don't know nearly as much as stock exchanges. But in my opinion, that's where all the fun happens, because in futures exchange, the exchange can actually choose what they list. Whereas with the New York Stock Exchange, for example, to an extent, they can approve and not approve different companies for listing, but they're listing public companies. Whereas on a futures exchange, you're listing different contracts. So there's a lot more financial engineering that goes into it, a lot more thought that goes into it. So I encourage people who are interested to take a look at two books. There's a book called Man of the Futures, which is about Leo Melamed, who is a key player in the development of the futures world. He was the one who created foreign exchange futures markets, among many other products that have ultimately been life-changing. He was the one who really spearheaded index futures, which are now mainstream. So there's a lot of interesting stuff there. And then there's another book called Zero Sum Game, which talks about the Chicago Board of Trade, also known as CBOT, during their acquisition period with the CME Group, which is now the biggest futures exchange in the world, kind of the two big Chicago exchanges merging with each other. And it's told from the perspective, I think it was their chief marketing officer at the time. So those are both so those are both really great books to learn more about the history of futures exchanges.
Because the history of stock exchanges is just like 20 dudes in a room speculating about a company that might go up in our time. Well, in these times, it was gold rush, right? Most of them, it was petroleum, it was steel. And it was like, okay, yeah, this company might go up. Let's invest in it so that it can grow faster. And in a year or so, we'll ask or money back, most probably, or we're just going to hold the stock. Is that a fair and accurate way to describe how it all started?
For stock markets, I guess you could say there might be a little more speculation, but for futures markets, they actually started out to serve a very specific purpose, and that's hedging. So I'll give you an example. There's a reason the biggest futures markets and one of the oldest futures markets in the world, the Chicago Board of Trade, started in the 1800s in Chicago, right? Chicago was at the center of all the trade routes in America. And so you have to wonder, why did it start there? It's because people came to Chicago to actually trade. And they were trading, for example, they were selling their wheat, they were selling their they were selling their pork barrels, they were selling everything. And so these farmers needed a way to make sure that even if they had a bad crop one year for wheat, for example, that they make the same amount of money. So what they might do is they might say, listen, if I have a bad crop this year, other people might also have a bad crop that year. So that's going to make the price of wheat go up if I produce less wheat, right? So I can buy a wheat future, and that wheat future will pay me money if the prices of wheat go up. So I can sell my wheat right now. If I get more wheat from my crop, then I sell more of it, but it's for less money, so I'm fine. But if I sell less of it, right, I'm not screwed. I just get way more money from these futures contracts that help me hedge my risk. And so it was actually much less speculation and way more professionals just trying to make sure that they can predict their income in advance.
Understanding the world economy is like one of the funnest, most fun thing to do. It's very intellectually stimulating, which is why a bunch of folks go into finance. It's not all bros. And I really like that. And well, the bro and testosterone stuff is the betting part, right? We all love to bet. I mean, when I get with my friends, there's a reason why we often end up around a poker table. It's just that, like, okay, here's my point, here's my thesis. I think I'm gonna be right. I'm going all in, It's very intellectually stimulating, and it's so complex, right? There's so many elements to this world economy. Probably need to go, Ken. We would need to do a round two because I have other questions, but it's been very insightful. Thank you for showing up today. Where can people find out more about you?
Yeah, so thank you for having me. It's been a pleasure. Would love to chat again. People can find us at FluidInvesting.